Hey everyone, this is Russ Thornton with Wealth Care for Women in Atlanta. Today, I'm looking forward to introducing you to a friend and colleague, Hank Sanders. Hank is a VP with OneTrust Home Loans. And before I turn it over to him, I want to preface our conversation by saying that, like I'm sure many of you out there that may be watching this, probably have a negative connotation or negative association when it comes to things like reverse mortgages. Today, we're going to dispel some of those misconceptions and myths, talk a little bit about how a tool like a reverse mortgage could play a strategic role in your retirement planning. If you have any questions or comments as we go, just please type those in the chat box. I'll keep an eye on that. And then at the end, we're going to shoot to keep this around 30 minutes. At the end, if there's any Q&A, we can tackle that. So with that, Hank, I will turn it over to you, my friend.
Fantastic. Thank you, Russ. Good to be with you today. So Russ mentioned we are going to be talking about the dreaded reverse mortgage, right? And so hopefully at the end of this, you'll have a different perspective on how this is actually being used now as a strategic financial planning tool and not a last resort. We've focused for 6 years now helping Russ and his peers, successful financial planners around the country, get this integrated into their practice to where they can help their higher net worth, mass affluent clients monetize, evaluate whether the home equity that they have can help solve challenges or improve retirement outcomes. And so covering a lot of information today. Just hopefully we'll consider this as just kind of an entry conversation to then take the next step if it makes sense to have the conversation with Russ to look and see if this is something that specifically in your situation would make sense to consider. All right, so kind of our agenda, our little roadmap here. We'll cover a lot. Probably not going to be an exhaustive explanation of everything, but when you think about retirement, you're accumulating assets, and then you cross into this distribution phase where everything changes. The risk goes up. Russ moves through that very challenging time with you all as his clients to be able to navigate all the challenges that we have and what's behind door number 2. And we're certainly seeing some of that now and here at home and around the world and in the financial markets. And so everyone's situation is completely unique. So there's no universal, everyone should do this or no one should do it. But when you think about some common concerns that once people cross into retirement, most of us are looking at a couple of things. First of all, we don't want to outlive our resources, right? We know we're living longer, and so we want our money to be around at least as long as we are, right? The other thing that we're worried about, and we're seeing that we haven't seen in 40 years, is this nasty inflation, right? Nobody wants to back up in lifestyle, and so the ability to have your lifestyle maintained throughout a long retirement is essential. And then the other thing is life is uncertain. There are things that happen to us, and we need to be able to access riskless, safe investments. And so this access to liquidity is vital. And then if those things are taken care of, most of us have people that we love and things that we care about. And so we want our life's work to have some meaning for those people and those things. And so the ability to have something to make a positive impact on those is vital as well. And you see that stat there. Again, everybody's unique, specific, their plan. But if we look across all retired folks in this country, on average, 70% of their net worth is tied up in their home equity. And so it just makes sense to bring that in as something to be evaluated to see if it helps solve retirement challenges or improves a range of retirement outcomes. And what you'll see, we're mostly going to be talking about the home equity conversion mortgage today. That's the FHA insured version of reverse mortgage. And you'll see that it actually can address each of those broad retirement concerns that we all have. And so if we're going to bring in home equity into a strategic plan, how do you access it? Well, you can sell the house. All right, that's certainly one way to get your hands on the sale proceeds of your home and use home equity. Now you have another planning decision to make. Where you're going to live. You're going to buy another house. What impact does that have? You can do a cash out refinance. We all know that retirement planning, one of the big challenges is cash flow. And so if you're refinancing into a traditional type mortgage, you're going to have a cash flow impact. As a planner, we're all taught that the home equity line of credit, the HELOCs, are a good emergency fund way to have that in place once somebody retires, and may be the right thing in your specific situation. But there are some specific characteristics to it, and I'm going to contrast that with the line of credit that's available through the home equity conversion mortgage, reverse mortgage. And so even though the HELOCs are free or certainly inexpensive, depending on your relationship with your financial institution, there are some things about them that or make them more appropriate for short-term needs, not long-term retirement needs. For instance, if you use a home equity line of credit, we now have that cash flow impact. There's typically an interest-only payment required, and then it amortizes, so you have an additional cash flow impact. If you need access to more equity, that means your home has to be appreciating in value, then it has to be reappraised. You have to requalify for that higher loan capacity. And then there's no guarantee with them. We certainly saw that in 2008 and 9 in the financial crisis, and we saw a little bit of it happen again at the beginning of COVID, where banks would stop those lines and actually take some of them away. So there's no real guarantee that they're going to be there when you need them. And so the other way, obviously, we're talking about reverse mortgages, and so we're going to unpack the way these things could potentially work inside of a strategic plan. So a couple of points is on the home equity conversion mortgage, the FHA insured version, 62 is the age, minimum age that one of the borrowers has to attain. There's no upper age limit, but 62 is the minimum age. And then the non-insured, non-FHA insured versions, the proprietary, they're not available in every state. They do drop down until younger ages, 55 and older. They go into much higher home values. None of them yet have the same features that the home equity conversion mortgage has, but they are available and they could make sense depending upon your unique situation. One of the keys that you'll hear as we talk about these things is that there's a lot of flexibility involved. With any sort of other mortgage, there's a principal and interest payment required. With these, it's just a lien on the property. There's nothing strange about it. The lender doesn't own the property. It's just a lien against the property that gives you the flexibility whether or not to make the principal and interest payment. Okay, with all mortgages, you're going to have to continue to pay your real estate taxes and your homeowner's insurance. With these, though, you have that flexibility whether or not to make the payment. Lots of flexibility on how they can be set up. They can be set up as a guaranteed monthly income. They can be set up as a term payment if you're not retired yet and trying to maximize and optimize your Social Security claiming strategies. We're seeing a lot of folks bring this in as a planning tool to be able to create a much more significant wealth impact by delaying the start of Social Security. And then the biggie to really understand is this line of credit, and I'll show you a couple of examples. One of the keys that's absolutely critical with this is that it has to be done on a primary residence. Now, they can be used, the loan can be used to purchase vacation homes or second homes, but the loan itself has to be on the primary residence, and the borrower has to live there. So once you sell the property, move out, then that would be a due clause on the loan. And then a meaningful thing that's happening now in the U.S. is we're probably going into higher tax rates, it looks like, and so this is another tax-free resource that can be utilized as part of your overall retirement plan. All right, so let's look at a few cases and examples of how this works. This first one is just a simple example, just to give you an idea of the potential power of this line of credit. And there's nothing else in the financial world that does this. And so this example is based on a $600,000 home. And the three things that are going to be used to determine how much is available, what's the credit facility that's available, is going to be the value of the home, the age of the youngest borrower, and current interest rates. Okay, so for this 65-year-old that we're using in this example with the $600,000 home, they have about $216 and change available to them. There's cost involved, like with everything else in this world. There's insurance, there's mortgage insurance that allows the features that you'll see here in a minute to be in place. And so those could be paid from another source. If not, you can make them as part of the loan, so you're not out of pocket. And so what we're going to show in this example is we're going to leave all the cost involved in this. And so what ends up being available to this particular borrower is about $195,000. And you can see the current interest rates there. And what's unique about this is that initial amount that's available begins to increase right after the loan closes. Okay. And so the current rates, about, a little under 7%, not too different than the 30-year traditional mortgages. And so let's look at see what happens over time. With this $600,000 home, we're going to show it growing at 4%. We look across this country over the long term, and that's been the average. We've certainly seen much higher growth rates in real estate for the last few years. Who knows what's going to happen? We're already giving some of that back, and a lot of smart folks are forecasting that we're going to give a lot of it back if we can't get some things straightened out in our country. But anyway, so we're showing 4% growth. So 600 becomes almost 1.6 million 25 years later at a 4% growth rate. There's our initial credit facility, the 216.6. You can see the very next year, it's already up to 231. 25 years later, it's now up to 1.2 million. Okay. The balance that we had in there, the 20,000 and change, we could make a payment. In this example, we don't. And so it continues to grow at that same interest rate. And so the 20,849, 25 years later, 115,861 is owed on this loan as a mortgage balance. And here's where the magic happens. That available credit in this example, we're not showing the borrower using that at all. So our 195,000 that was available day one is up to over $1 million 25 years later. At any point, the borrower could have accessed that tax-free to use for any purpose. And what's amazing about this feature of this particular loan structure is with that $600,000 home, we could show it flatlining. So 25 years later, instead of the home being worth 1.6 million, it could still be worth 600,000, or it could be worth 200,000 if we have a real estate collapse. It doesn't matter. It wouldn't change anything else on that page. So you literally are looking at a solution that could give you access to equity above the value of the property. And so we're, again, especially with some of the challenges that we're seeing in the financial markets and maybe the real estate markets, this is an interesting opportunity to maybe put a floor under a portion of that equity that we've all sort of enjoyed over the last few years and give it a growth rate, regardless of what may happen down the road to our real estate. And so you can see graphically here, and this is pretty stark on this next slide, but at a 4% appreciation rate on your house value, your equity 25 years later ends up being about what's available. But if we show this with the real estate only appreciating at 1%, look what happens. Available equity is vastly over the actual equity in the home. So somebody could, so you see that crossover point there where the property value is surpassed by this principal limit, the available equity. And so you're truly able to create a hedge of protection, access to your home equity at a predictable growth rate, regardless of what's happening to the underlying real estate. So nothing else in the world works like that. Okay. And so it's always a good idea, I think, to look at something like that and go, well, okay, well, that's cool. So what? Right. So in Russ's world, you know, as a financial planner, so what could that possibly do for his clients? Well, especially, you know, now we're seeing some volatility in the markets, and there's something that we all know as financial planners is we can do a great job of creating investment strategies and solutions. What we can't predict, we can't control the markets, right? We don't know when they're going to be up, when they're going to be down. And so, and it matters to people who have crossed over into this distribution phase of retirement. And we all know that if you happen to be unlucky and retire into a volatile, bad market, it can really shorten the longevity of how long your assets last. And it really just comes down to whether you end up being lucky or unlucky. And just a quick example of that, here's somebody that retired in 2000, and they've got $1 million. They're taking a distribution rate that's inflated to keep up. Well, they're out of money at age 75. And you can see in that first column, their first few years of retirement, their investment portfolio was negative. Well, their lucky neighbor didn't retire until 3 years later. So same rates of return on the investment strategy, they just happened a little bit later. And so their lucky neighbor that retired 3 years behind them had positive returns in the first few years of their retirement. And so, you know, you can see the outcome there. Not only did they not run out of money, you know, their portfolios up to almost 1.8 million. Okay. So that's real. And so there's a lot of really smart people in the financial planning profession that have done studies about what do you do as a financial planner to build that buffer asset in, a way to mitigate that risk that could be present with some of your clients. And so they've looked at using these home equity conversion mortgage lines of credit as a potential buffer asset. And so show you a quick example. Now, there's going to be a lot of numbers on the page here, but I'll give you an idea of what's happening. The first chart here you're going to see is sort of the traditional way of thinking about home equity. If I were to run out of money in my portfolio, then I'll turn to this home equity and use it. And you can see that. So they've, you know, first part of retirement, they set up the home equity conversion mortgage line of credit. It's growing. And you can see that the traditional thought here is we're going to continue to draw from our portfolio for the income that we need. And they run out of money at age 78. Okay. And then you can see the line of credit draw, and they're fine for the next 10 years or 11 years, pulling from that tax-free resource. Well, what happens when you net all of that out, the house appreciated, and the house is now worth about $3 million. And so when they pay off the mortgage balance, the net residual estate, what goes to the heirs, is a little over $1 million, not $1 million, whatever that is, $1,065,000, right? So let's look now, we're not going to change anything, right? The investment rates of returns, the income that we're pulling, the inflation rate, everything's the same. We're just going to consider this home equity line of credit as a usable asset in real time to use strategically based on what's happening with the investment account. Okay. And so what you'll see this time is every time there's a negative return on the investment side, we're going to pull from this line of credit. We're going to use that tax-free other asset that the client has. And so pretty amazing math that happens here just by using the same assets better. The client is way ahead. Okay. You're more than almost $1.3 million to the good just by using those same assets in a strategic way versus linear. If I run out of money, then I use the other asset. So lots of studies out there. You know, Russ and I have, you know, talked about and looked at a lot of stuff. And it doesn't really seem to matter whether it's a large house value relative to the investment or the other way around. When you bring in a strategic focus on this additional resource, it ends up being a really positive thing for the family and their wealth impact. Okay. That's just another graph. Another so what? So one of the challenges that happens to us as we age is we have an increased risk of needing healthcare, right? The last I saw, about a 70% chance of somebody once they cross age 65 requiring additional healthcare in retirement. And there's a specific type of insurance that pays for this. A lot of us don't have it. For a lot of reasons, from a cash flow perspective or underwriting perspective, we wouldn't qualify for the type of insurance that pays for this type of healthcare. And so, but now what we're seeing is financial planners being able to set up an additional resource for clients in the event that they may have this additional healthcare need down the road. So take an existing asset and activate it in a way to where it becomes useful just in case the client were to be unfortunate and have this healthcare event. So here's the setup: 750 home. These clients have about $1.2 million in financial assets between their tax deferred and their non-qualified assets. They need about $95,000 in income. They've got half-ish of that covered in Social Security together, but they're pulling about $54,000 from those assets for the income they need on an inflation-adjusted basis. So what will happen is John, it's always the guy, John's going to have a health event about 10 years into retirement. So at 75, he's going to need additional in-home care. Current cost for that where they are is about 80 grand a year. So that's going to be inflated. And so when Russ uses his financial planning software to, when you sit down with him and figure out, the most important things that you want to achieve in this one life that you're going to get to live in the order of their importance, Russ can model your ability to do that, right? Uses Monte Carlo simulation to figure out the probability of that happening. And so when we pull this case into Russ's financial planning software, we showed that they were in the comfort zone, 84% probability comfort making those lifestyle for the rest of their retirement life. We model in this additional cost, this healthcare cost, and that drops into a risk zone, right? It drops to 57. When we activate and utilize that resource that they put in place, the home equity conversion mortgage line of credit. So now we're able to pull $115,000 a year to offset those healthcare expenses that the husband John is incurring. They're back up now. If they lived age 95, where this is modeled, they're back up in that comfort zone. So very important to be able to demonstrate, hey, is this something that adds value above the cost of doing it or not? In this case, it absolutely was. So a few more strategic uses, asset strategy. Again, you either own a home and have home equity at a level to where this is possible or not, right? But if you do, it probably makes sense to look at it not in isolation, but across the silos, if you will, as an integrated potential tool to see if it can help you solve challenges that you may have in your retirement plan or improve a range of outcomes available to you. We looked at that case with the in-home care. A lot of us have this exposure. A lot of our fellow Americans out there have the risk of having their retirement strategy blown up because they don't have the type of insurance that would activate in that event. So this could potentially be a resource for those folks. We talked a little bit about Social Security bridging. The wealth impact of claiming Social Security if you're not retired yet, the longer you delay it all the way out to as late as age 70, you get about an 8% increase in the amount of Social Security. So you have there's a crossover point, obviously, based on your longevity. But if you have, let's call it 8 years, if you live in retirement longer than 8 years, you're going to have a net positive effect of having delayed that Social Security. So this could be an additional tool to help you do that. There's actually a way to buy a home. If you're looking to upsize, downsize, right size, move closer to the kids, grandkids, whatever, and want to use this strategy to purchase a home. Well, that same math, house value, interest rates, age, is going to determine an amount that's going to be available to you. And so let's say you're wanting to buy a $600,000 home. Well, you've sold a $600,000 home, you've had it paid off. Well, you might be able to use a strategy to, let's call it, you use, 350, 400,000 of that sales proceeds, and then put the balance into your retirement strategy or lifestyle or whatever it may be, and still have the new home that you wanted to be in without having to make a principal and interest payment. So we can talk about that if it makes sense. Home repair, again, another way to have a resource that's not going to impact your cash flow. There's a lot of advanced planning things around tax overlays with these solutions. Uncle Sam lets us deduct mortgage interest if we have acquisition indebtedness. So if we buy a house, build a house, or substantially improve a house, that interest is potentially deductible if you itemize, and you can supersede the standard deduction. And so one of the things that's happening now is you can actually create a new tax asset with these, right? And so if it makes sense at some point to move money from a traditional IRA that's going to be taxable, that may not be as attractive for a non-spouse heir to inherit it, because they've got to take the distribution now with the new regulations over a 10-year period instead of over their lifetime. Well, a lot of advisors are considering moving money from a traditional IRA to a tax-free Roth account. There's tax due on the conversion. There's a possibility that you could have a tax offset through these if we had acquisition indebtedness. Again, more advanced planning to talk about that we can get into here. Again, flexibility, paying off an existing mortgage to free up the cash flow for whatever reason. We're seeing a lot of folks look at this as an additional strategy to do advanced inheritance. Maybe your plan looks fantastic. You've got enough resources to be able to live the life you want to live, but there are some extra things you would like to do. Give to your church, give to your, pay your some tuition for a grandchild to go to college, or give to your kids or whatever while you're still around. This is a way you can potentially have an additional resource to do that without impacting your personal retirement. And then the last one here is this line of credit. Life is uncertain. If the last few years haven't taught us anything else, is that we have no idea, what could be behind door number 2 down the road. And so having this additional monetized resource that's either there or not in your personal situation to be able to use could be important. Okay. And then I'll wrap up here. Our team, we support Russ. We have lots of experience also as financial planners. I started in '86 right out of college doing it. Past 6 years though, we have focused exclusively on helping successful financial advisors bring this into their practice to serve their clients. And so OneTrust, we're agnostic really as to the type of mortgage solutions. We specialize in the 55 and older market, but there's lots of things that we can do. But probably the most underutilized and misunderstood tool is this reverse mortgage strategy. And so that's where we've spent a lot of time and developed a lot of skill and wisdom that we can help support Russ and his successful peers across the country. So Russ, that is, I wasn't even looking at the clock. You didn't cut me off there, or grab the hook and drag me out. So I guess I didn't run too far over.
No, you're right on the money. So by my clock, you're right at 30 minutes. So well done.
Perfect.
Bravo,
How about
bravo.
that? I got lucky.
Yeah, so Hank, thank you. As Hank mentioned at the top of the call, this is really just meant to be kind of an overview and an educational introduction. Having said that, if anyone has any questions, type them in the chat box or unmute yourself and speak up. We're happy to address anything that's on your mind right now. I do want to be very clear, and I've actually had conversations with a couple of you about this already. there's not a sales pitch here. This is not something that I'm gonna come at you heavy-handedly and say that you need this. But as a fiduciary and fulfilling my responsibility to you as an advisor, this is an interesting strategy that I just want to start introducing to folks. So that's the reason that I'm talking to Hank, and that I wanted to introduce Hank to you guys, just to let you know this is out there. If I had to guess, it probably doesn't make sense for most people, but for the people where it does make sense, it can make a huge positive impact on your retirement planning. So I'll give it another minute. Any questions about reverse mortgages, anything that Hank covered, anything he didn't cover, speak up or type that in the chat box. And I'll give that just a moment before we wrap it up today.
Yeah, if the two words reverse mortgage scare off people, why do they call it another reverse mortgage? Why don't they just call it a HECM? And how long has this kind of deal been around? It seems like it should be a thing that everybody's rushing at age 62 to get a HECM. I mean, this is the first I've ever heard of. I've certainly heard of reverse mortgages. You can't watch TV without seeing Tom Selleck in them.
That's so spot on. Yes, the probably everything in this world comes with some baggage, right? Whether you're talking about plumbing or neurosurgery or annuities or attorneys or whatever. Everything has had bad experiences, and so the reverse mortgage industry is no exception to that. Some of it was justified, the negative press, and some of it was just misunderstandings, I think. But at the end of the day, your point is that the technical name is home equity conversion mortgage, and that's the FHA HUD insured version. Okay, and so that is the technical name. They've been around a long time. I guess when Reagan was in office, and in the mid 80s is where the version that's out there now that got formalized. There's been several changes over the years. The most significant recent change happened in, I think it was 2017. And so lots of advancements, everything that's happened to the program has really been, best I can tell, set up to for the benefit of the borrower, the clients. There's a mandatory third party interview, that evaluation that has to happen. So regardless of the company, the loan officer that does one of these loans, the borrower actually goes through an interview session with a HUD approved counseling session. So there's it's almost impossible now to misunderstand what you're getting into as a borrower, because you've got somebody that's completely disinterested in whether or not you do it. They just want their whole job is to evaluate your understanding of the cost and the structure and the obligations and all that. And so there are guardrails and safety nets now around this program that didn't exist in the past. But yeah, your other point is again spot on. I've spent 6 years now focused in on this, mostly concentrating with folks like Russ, that deal with clients that have resources, that need gifted financial planners. Russ said the word fiduciary. His obligation is to do the best thing, the right thing for his clients. And so, our focus there has been to take this information out to the planning community. And if it's not universal, it's pretty close. The reaction that I get from financial planners the first time they see this and get their head around it is, why doesn't everybody do this? And why didn't I know about this? I've been a financial planner for 40 years, and now you're showing me something potentially very meaningful to my clients, and I didn't know about it, right? And so that's changing, by the way. All of the when an advisor goes and gets advanced designation, certified financial planner, any sort of retirement specific designation, all the associations that advisors belong to, like the Financial Planning Association or NAFA or NAFA, they're all now bringing this in as formal education for financial planners. And so they get continuing education credits to be able to learn about this. So I think, again, don't know what the future holds, but just a trajectory of what we've experienced, I think this is going to become way more mainstream than it's ever been. And, it's one thing to run television commercials targeted at individuals and, again, about something that may have a negative, connotation associated to it versus educating professional advisors with a fiduciary responsibility to then evaluate it in the context of an overall plan for their clients. So I do think we're going to see this become much more widespread in the months and years to come.
Okay, thank you.
Mm-hmm.
Yeah, thanks for that question, Anne Marie. And if anyone has any other questions or comments, please just speak up. One thing I did want to mention before we wrap up, as a fiduciary, I cannot, nor do I accept compensation or commissions from anyone other than the fees that my clients pay to me. So if one of you listening to this call says, wow, this is great, I want to do this, I think Hank and OneTrust is a great solution. But I have no skin in the game. I don't get any compensation, whether you go to Hank or somewhere else to get this in place. I will warn you, however, and I think Hank would echo this, there are a lot of people out there that sell or represent reverse mortgages that don't have as thorough an understanding of what it is and how it can work, and more importantly, how it can maybe not work, as I've found with getting to know Hank and Ryan and OneTrust. So I just want to throw that out there. I'm just bringing this to you and my other clients as introducing a strategy that I think is interesting and could have application. But I have no financial or other incentive for people to do this or to not do this. I just want you to do it if you think it makes sense. And this is something that we can discuss further, and we can bring Hank into the conversation if and when it makes sense. So thanks again for that question, Anne Marie. Anybody else have a question before we wrap it up? I don't want to take up too much of your day. Hank, any closing comments for you before we wrap it up?
No, I think your parting comment there was absolutely spot on. It's, this is not something that everyone should do. There's, I don't believe there is a financial planning. There is a universal, everyone, no one. The evaluation of this or any other type of strategy or solution needs to be evaluated with you specifically and your particular goals and set of situations and what you're trying to achieve in this life. And we can help you determine, if this is something that improves your situation or not. Either answer is okay.
Yeah. Well, thanks again, Hank. Thanks everyone for joining us. Any questions or comments before we wrap it up? Well, I wish everyone a very happy New Year, a very Merry Christmas. Enjoy the holidays, be safe, and I look forward to talking to all of you guys again very, very soon. Hank, thank you again.
Thank you, Russ. Nice to meet everyone. Yeah.
Thank you.
Take care.
Yep.